All right, so in this video, I'm going to talk a little bit about market ratios. So the first ratio I'm going to talk about is the price to earnings ratio. The price to earnings ratio is a ratio of the price per share for a share of stock divided by the earnings per share for that stock. So basically what we're finding here is how much we're paying per dollar of earnings. So if, for instance, a company has a stock price of $100 per share, and if they have, say, an earnings per share of $5 per share, then you take 100 divided by 5, and we would get a PE ratio of 20. So we'd basically be paying $20 um, per dollar of earnings when we buy the stock for $100. Now, if you look at a price to earnings ratio, generally you tend to think, we would want to pay less per dollar of earnings that we're getting. That's a general principle of finance and sort of business generally. The less we pay for what we are getting in return, the better off we're going to wind up being. So generally, you would tend to think that we'd want to have a lower PE ratio. And then if we're looking at things from a very broad perspective, say whole portfolios of stocks or things like that, that may actually be true. And there is some academic research that suggests that portfolios of stocks with lower PE ratios tend to perform a little bit better in the long run. But for an individual company, it's a little bit more complicated. And let's talk about why that's the case. So, if we're looking at a company or really any asset, the value of any asset or investment is the present value of all expected future cash flows. So when we look at this price per share, the price per share is really looking at what people expect the company to do in the future. And so it's based upon expectations. Um, Perhaps expectations of growth, perhaps enhanced profitability, etc. If I'm looking at the earnings per share figure in the denominator, the earnings per share figure is coming generally from the most recent earning income statement, something of that nature. And so therefore we have a little bit of a disconnect. The price tends to be forward looking and the earnings per share tends to be backward looking because it's from a prior period of time. And so you can get kind of an interesting disconnect there where the price per share may be reflecting what people expect the company to produce, whereas the earnings per share is backward looking, it's what has already occurred. And so as a result of that, there can be sort of that disconnect between the two. And so that means that for an individual company, it gets a little bit more complicated in terms of interpreting a PE ratio. So let me add a little bit more detail and give you some examples of kind of some things that would kind of complicate things a little bit. So what if I'm looking at a company that has barely been profitable so far, but we have significant expectations of profitability going forward? I think the early days of a technology or something like that. So it hasn't really been very profitable yet, but we're thinking it's going to be very profitable later. So if that's the case, then the price per share may well be elevated because the expectations of future profit are high, but the recent profit may be, pretty much nil, very little. And so we could have very low earnings per share currently, but the expectations are high, and that might even be warranted. It just depends on what happens. Now, the danger in that case, from an investing standpoint, is you're sort of betting an awful lot on growth, and so you're kind of counting that this growth and profitability and these future expected earnings are ultimately going to materialize, and they may not. So that's kind of an interesting, challenge there. But you could have a high PE ratio basically due to something like that, where expectations are high. But we could also get to a high PE ratio another way. Another way that we could get to a high PE ratio would be if, for instance, a company had a very unusual one-time event that depressed earnings. So, for instance, let's suppose a hurricane went through and caused severe damage to a company's facility that led to a one-time expense, an unusual item on the income statement that caused earnings to be very much lower in the most recent year. And so everybody who is analyzing the company recognizes, well, this isn't going to happen again, right? This is a very unusual one-off kind of a thing. So they're willing to pay relative to what typical earnings would be, even though the most recent earnings are quite a bit different. And so what can happen then is that the PE ratio could be somewhat elevated or it could look elevated. But the reality is, the reason why it looks elevated is not so much that the price has gone up a whole lot relative to the earnings, but just that there's a one-time fluke event that is basically um, causing the earnings to look low, and therefore it makes the ratio look high, even though it's just kind of a one-time event kind of a situation. So that can mean that even with a high PE ratio, it could be people are really betting on a future, which means they could be overpaying. But it could also be a one-time event type of situation. And as a result of the one-time event sort of situation, basically it looks high, but it's not really high relative to what's normal. But let's take a look at the other sort of extreme. If we had a low PE ratio, if we had a low PE ratio, at first blush, you'd be tempted to think, well, that sounds really good. We're paying less relative to the earnings the company's making. So this, I mean, this is good, right? I mean, what's not to like if we're paying less relative to the earnings that the company's making? Well, let's talk about kind of some ways that could arise. One possible way that could arise is if people's expectations about future profitability are poor, right? So in other words, if we're thinking the company just doesn't really have a good future here. So if we think the company doesn't have a good future, then in that case, our expectations of earnings, future earnings are low. And so the price may well be accounting for the fact that basically expectations are poor. And in that case, the earnings per share, they could have been great recently. The company could have been making plenty of money recently, but the expectation is that in the future, they're not going to be. So even though they were making money in the past, the price is reflecting what we expect them to do. And so it could be a situation in which it's a low PE ratio and it's not really necessarily a bargain. It might just be basically the company doesn't really have a future. So think carriage makers when automobiles were really gaining traction, or think typewriter companies when computers were really taking off, right? I mean, if you look at some of those kinds of companies, it's like the future was limited, it was bad, and so even if they had previously been quite profitable, people hit a point at which they kind of realized this is on the way out, and as a result of that the expectations of future earnings were lower, and so a low PE ratio in that case wouldn't necessarily indicate that you were getting a good deal by buying the stock at that price, but rather that the future was bad. So when you're looking at the PE ratio for an individual company, you really have to dig deeper to understand, how did the ratio become low, or if it was a high PE ratio, how did it become high? What led to the outcome? And then you could kind of gain some degree of an interpretation from that that might be reasonable. If you are looking at entire portfolios of stocks, there is some academic research to suggest that if you look at a broad group of stocks, so a whole bunch, not just a few, that have lower PE ratios and a whole bunch that have higher PE ratios, probably there's some suggestion that there's a fair chance that in the long run, the group of stocks with the lower PE ratios might actually get some higher returns there. And so sort of the idea of buying at a bargain, you're paying less relative to the earnings might be sort of winning out if we're doing a broad mixture of stocks. But if you're looking at any individual stock, all bets are off about that. And you really have to look in more depth to determine, what led to it looking low or high, and what does it mean, and so forth. Well, that brings us to the market to book ratio. So for the market to book ratio, we're looking at essentially the market value relative to the book value. So for the market value, we're looking at the price per share again. For book value, we're looking at BVPS, or book value per share. So let me kind of define that first. So book value per share is going to be the common equity divided by the number of common shares outstanding. So let's kind of walk our way through that for a moment. So let's suppose that I have a company that has no preferred stock, just to keep things nice and simple. And so if you think back to basic accounting, assets equals liabilities plus owner's equity. So if I take my assets and I subtract off the liabilities, what I'm left with is the common equity. So if I take that common equity and then I divide it by the number of common shares outstanding, that's going to tell me the dollar value on the books of the assets behind every share of common stock. Because really, if we take the assets minus the liabilities, what we're left with, that common equity, is theoretically the value of the assets that is sort of backing the shareholders' investment, the common equity. So I take that value of the assets as sort of backing the common equity, and I divide it by the number of shares to find out, so in essence, the dollar value of the assets behind each share of stock. Now, if I look at that and then I take the market value per share or the price per share and I divide it by that book value per share, I'm basically comparing how much the stock price is relative to the value of the assets on the books behind every share. Now, generally speaking, most of the time, what you're going to wind up with is a market to book ratio that is over one and probably well over one. And let's talk about that. The reason for that is the price per share is going to be linked to, generally in the long run, people's estimations of value. And so the value of any asset or investment is the present value of all expected future cash flows. And so what that means is people are going to value a share of stock based on the earnings that they expect the company to make or the cash flows they expect the company to make, not the dollar value of the assets they have on the books. So if I'm looking at the market value relative to the book value, generally this is going to be higher than one. And really, what's happening here is, if you think about it, people don't buy shares of stock well, most of the time, based upon the dollar value of the assets they have. It's based upon, what kind of income can it produce, what benefit can it produce. And the reality is, at some level, people don't really care that much about the dollar value of the assets behind the share. They care about the earnings the company is going to make. Now, there are some limits to that, and some exceptions to that. So it is worth knowing what is the dollar value of assets behind the share, because that might give you some inkling of an idea of, how might it turn out if things end badly, right? So if the company just went bankrupt tomorrow, what might I get in exchange? And so that's a sort of an idea about what that book value per share might be conveying. But it's important to note the qualifiers I had in there. What might I get? Because the reality is, if I look at the assets on the balance sheet, it's hard to know whether those assets are really worth what the balance sheet indicates or not. So let me give you some examples for that. If a company bought a whole bunch of land many, 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 many years ago, on the balance sheet, it's probably recorded at historical cost, whereas now it may be worth many times that. And as a result, when I calculate that book value per share, it may not really accurately reflect the true value of those assets. And therefore, that book value per share is actually kind of understating what's really behind those shares. On the other hand, if a company has a whole bunch of goodwill on their balance sheet in the assets, or perhaps some kind of intellectual property or something like that, it's possible that that is not really fully reflecting the true value, and it could actually be overstated. And this is why companies have to write down goodwill periodically, because they realize that the value of that line item on the asset side of the balance sheet isn't worth what they thought, and so then they have to actually reduce it. So if I'm looking at book value per share, to get a sense of just how much I could really count on the dollar value of the assets behind the share, you really would have to look at what kind of assets the company has, and just what kind of value it would really have if the company went bankrupt, for instance. But in general, if I'm looking at a market to book ratio, typically the ratio is going to be well over one, because the price is looking at the expectation of future earnings, whereas the book value is just looking at what's the dollar value of the assets on the books behind that share of stock. So generally speaking, the market to book ratio would be over one. But the lower it is, the less you're paying, at least relative to the assets that are behind the share. And so the thought would be, perhaps that means I'm getting a better deal in terms of that. A little bit more of a limit to the downside of how bad it could get, perhaps. But again, keep in mind that you really have to look at and analyze the nature of the assets. And you really want to look at the nature of the liabilities and things like that in order to really make a good determination. But that's the basic idea. All right, so you could also calculate various other market ratios, price to cash flow, price to free cash flow, and so on. But the idea is very similar to what I've discussed so far. All right, hopefully this video has been helpful. Thank you so much for watching, and have a great day.